Hello and welcome. In this lesson we will continue with the corporation tax. Hopefully this is the last lecture of our corporation tax and our ACCA basic syllabus. Alright, without wasting time we will move to our notes and we will look at the topics of our notes. Could you please move to page 79 of your lecture notes where it says closed companies. Now our topic today is a closed company, and the second topic is when the company buys back their own shares. So first they issue the shares to the shareholder, but if the shareholders want to sell the shares, or if the company want to buy the shares, then the company buy back the shares. So we'll see how to treat that as well. So first things first topic is closed company. If you remember during the course, during the lectures, I think one of the lectures, I think it was middle of our syllabus, I told you about closed companies. Actually I've told you many times because closed companies was mentioned in many places in our syllabus. Now closed company is a company which is managed by the close family members, I told you, which was easier understanding of the closed company. Alright, now we will look in detail what are the closed companies and are there any treatment of that. So say for example, if there is a closed company who is managed by the family members, close family members, then what happens is, although they are a family managed company, they are a close family company, what if the company issues a loan to one of the shareholders, which are eventually the family members? So what if the company give a loan to the shareholder? What if they give any benefit to the shareholder? How will that be treated? So that will be our subject area for closed companies. All right. So if you could please move to your notes on page 79, please. Actually I will share the screen with you as well, so that you can see on the screen as well. Here you go. I've shared the screen with you. It is closed company on page 79. Now broadly, a closed company, it says, is a one that is under the control of either 5 or fewer shareholders or any number of directors. Right? So what is a closed company? A closed company is a company which is owned by the 5 or fewer shareholders. So the maximum shareholders could be 5. So if it is owned by 5 or fewer shareholders or any number of directors. So if as far as directors are concerned, directors could be as many as you want. Excuse me, but the shareholders, maximum shareholders can be 5 shareholders. So 5 or fewer shareholders or any number of directors. It says shareholding directors means someone who holds the shares and is also a director is called shareholding directors. Now shareholders or shareholder directors are known as participators. So it says shareholders, or it's not R, it's or. Please make sure you rectify the mistake. Shareholders or shareholding directors are known as participators. So shareholders and shareholder directors are known as participators. Direct relatives, if there are any direct relatives, and business partners of the participators are known as associates. So if there are any relatives of the participators, then they are known as associates. When a closed company makes a loan to one of these participators or associates, it must make a tax payment to HMRC equal to 25% of the loan. Say for example, if you make a loan of £100 to one of the shareholders or participators or their relatives, then you will have to pay 25% of the loan to HMRC. Now why we do that? Because HMRC says that whenever you make a loan, you have to pay me 25% of that. That will be a charge. However, when the shareholder pays back to the company, then HMRC will pay you back there as well. Alright, so if the shareholders pays back to the company whatever he took the loan from the closed company, then HMRC will pay you back that 25%. Or in other case, if the company writes off that amount, if the company writes off, say, I want to receive it, if the company writes off that amount in the accounts, in that case as well, the HMRC will pay you back. Now that 25%, although will be paid back by HMRC, but what about that amount which the shareholders has taken? What about that amount? Now that amount will be treated as dividend. Let's see on the notes, please. Alright, so it says 25% of the loan. If the loan is repaid, HMRC will repay this tax charge. When all or the part of the loan is repaid by the participator to the company, or the company writes off all or part of the loan, then the company can reclaim or a corresponding part of the tax charge paid over to HMRC. So if the loan is paid back or company writes off full or the part of the loan, then you can ask HMRC to pay you back a proportion of that, 25%. Now, if the loan is later written off, then the amount of the loan is written off, then it is treated as participator's net dividend income. As I said, now how will it be treated as for shareholders? It will be treated as net dividend. Now, it is not gross dividend, so it is a net dividend. Whatever the amount is, we'll have to gross it up and we'll put into the income tax pro forma under dividends, and it will be taxed accordingly. Right, then it says benefits. Say for example, if car is given by a closed company to a participator or their associates who does not work for the company, are treated as receiving net dividend from the company. So whoever is not receiving, whoever is not working for the company will be treated as net dividend. So all the benefits will be treated as net dividend. The amount of deemed net dividend is the amount calculated under the normal benefit rules. Now how will we calculate if the car has been provided or if a laptop has been provided? Say for example, if a laptop has been provided, now that laptop is provided by a closed company to a shareholder or a participator. Now laptop is charged at the rate of 20% because it is the other tax, if you remember. So we'll take 20% of that, and that 20% will be, say for example, it was £160 or say for example £180 it was. Now if it was £180, now putting into our income tax pro forma, we will always gross it up because we will assume that it is a dividend. So we'll multiply it by 100 and divide it by 90, and it will be taxed according to the dividend tax rates. Alright, now next thing is the purchase by a company of its own shares. Now what happens is that when company buys its own shares, when the company buys its own shares, then there are two types of treatment which they can make. Alright, so what company does is they issue the shares to the shareholders. Now the shareholders are they have received the shares. Now they are keeping the shares. After some time, if the shareholders feel that I want to sell the shares to the company, and if the company says I want to buy the shares, now company always can buy the shares. Now if the company buys back its own shares, then what would be the treatment? That's our subject area. Now there are two types of treatment. One is that it will be treated as income, and other one is it will be treated as a capital. Right? Now if it is treated as income, you know that if it is treated as income, it will be taxed according to the income tax. However, if it is treated as a capital, then it will be taxed according to the capital gains tax. So let's look at the income treatment. If a company buys its own shares for more than amount originally subscribed for, general tax rules state that there is a distribution of the excess. What does the distribution mean? Distribution means dividends. So whatever the excess will be over the subscription price, it will be taken as distribution, it will be taken as dividend. Recipient of such distributions are treated in the same way as recipient of the ordinary dividend from income tax. So it will be treated as a normal dividend. The shareholder will also pay capital gains tax on the shares sold to the company. How it will be calculated? So they will pay the income tax, but the income tax will be paid on the dividends. It will be assumed as a dividend. And they will also pay capital gains tax. How will we calculate the capital gains tax? The sales proceeds will be original value of the shares. So sales proceeds will be original value of the shares. And the next treatment is called a capital treatment. Now if we treat it as a capital, then we will consider it as a capital gains tax. However, we cannot choose to do that. It's not up to us to choose that. There are certain conditions. If certain conditions are met, then only then we can choose this option. Alright, so there are two treatments. One is income treatment, other one is capital treatment. But capital treatment is it's not up to us to choose that. There are certain conditions. If we meet that, or if the shareholder meet that, then we will be able to choose that option. Alright. Sorry, I think I forgot to move down the screen. I assume that you've already downloaded the notes anyway. So let's look at the second second method, which is a capital treatment. However, capital gains tax disposal automatically occurs rather than an income distribution. Right? When an unquoted trading company buys back its own shares in order to benefit its trade and certain other conditions are satisfied, the benefit to trade test will be satisfied where? Alright, so how to do the capital treatment? So when the company buys back its own shares and some certain conditions are met, there is a mistake in this notes as well. I think the sentence start with the however word. No sentence start with the however. So a capital gains tax disposal automatically occurs. It starts from A. Please, I beg your pardon. There are lots of mistakes in the notes. So it starts with A. So a capital gains tax disposal automatically occurs rather than an income distribution when an unquoted trading company buys back its own shares in order to benefit its trade and certain other conditions are met, are satisfied. So if it will be treated as capital gains tax when an unquoted trading company buys back its own shares and certain other conditions are met as well. So it will be unquoted trading company and certain other conditions will need to be met as well. Now, what are the conditions? There is a certain tests first. So first test is called benefit to trade test. If that test is satisfied, then we will look at the shareholder as well. Now this test, what is the test? It says the test name is benefit to the trade. Now as the name suggests that it is benefit to the trade. Now company is buying back its own shares in order to benefit its own company, in order to benefit the trade of the company. Now how can they benefit the trade of the company by buying back its own shares? It doesn't make any sense. But sometimes if you buy back your own shares, it benefits your own trade. How? Let's read the notes. First one, it says the dissident and disruptive shareholder is buyout. Now say for example, if the shareholder was disruptive, he was constantly saying to you, oh, please increase the dividend, please do something to increase the share price or something like that. So he was disturbing you. So he was forcing you to take some action all the while, or he was doing something else. So he was disruptive, and he was not only bad for you, and he was disturbing other shareholders as well. Now if you buy back shares from that shareholder, that will benefit the trade, won't it? The second condition, it says the proprietor wishes to retire to make way for new management. Now if some directors or proprietors want to retire so that the new management can take over, because it will take some time to get experts into the company. So whenever a good leader always leaves some time, and good leader always thinks about who will be the next one to lead. So that's why the proprietor wishes to retire to make way for new management. So that is a sign of a good leader, you can say. And the next one is an outside investor who provided equity wishes to withdraw his investment. Now if other investor, which was outside investor, he invested first, but he want to withdraw the investment, so that would benefit as well, because he's an outside investor, so it will benefit the trade. And the last one is if a shareholder dies and his personal representative do not wish to retain the shares. Now in that case as well, you will have to buy back the shares and give them their money back. All right, so this is the benefit to trade test. All right, now the conditions to be satisfied by the vendor shareholder are as follows. Now these are the conditions that will be satisfied, that must be satisfied by the shareholder who hold the shares in the company. Now please read carefully. Now the conditions satisfied by the vendor shareholder. The first one is he must be resident and ordinary resident in the UK when the purchase is made. Must be resident and ordinary resident when the purchase is made. The second one is that the shares must have been owned by the vendor or his spouse throughout the 5 years preceding the purchase. So the shares must have been owned by his own self or the spouse for 5 years preceding the purchase. So 5 years is the period of ownership. Now, if one of the spouse dies, then the ownership period should be 3 instead of 5 years. So say, for example, Mr. A's wife held the shares, and then she died after holding the shares for 2 years. Then Mr. A, I mean her husband, took over the shares, and then he held the shares for another 1 year. So the total ownership period will be considered, including that of their own wife. So total period will be 3 years in this case, and the condition will be satisfied. As it says here, if one of the spouse dies, then the ownership period should be 3 years instead of 5 years. All right. Now the third one is a vendor and his spouse must be, as a result of purchase, have their interest in the company reduced to 75% or less of their interest before the disposal. Excuse me. Please tick this one, which is C. This is most important of all. This is C and D are very important and very, very, complex one to understand. Please make sure you read both of them, C and D, very carefully. Now, what does he say? That when we are doing the calculation, and it is the examiner most of the time examine this portion. He always examine the capital treatment most of the times, and because it has got more marks in it. Now, when doing the calculation, we will see the question as well on that in our this video, or probably the next video of this lecture. So we'll see the capital treatment. Now, what happens is that we will have to see that how much was the shareholding of this specific shareholder. Say, for example, he was a Mr. A. Now, how much holding he has in the company before the company buys his own, and before the company buys his shares. Say, for example, he held 100 shares before the company bought the shares. Now, his 100 shares, how many shares he had? How many shares the company has in total? The company has total shares of £1,000. He had 100 shares. Now, how much is the holding? 100 divided by 1,000. So he holds 10% shares in the company. Now, that is before the company buys the shares. Now, say, for example, company buys 50 shares of that shareholder. So if the company buys 50 shares of that shareholder, so his shareholding after the company buys the shares is 50 shares out of how many? Out of 950 instead of 1,000 shares. You might be confusing yourself. Some of you might have got it. Now, what happened is that the total shares of the company was 1,000 shares before the company bought the shares of this shareholder. Total shares was 1,000 shares. This shareholder had 100 shares. Total shares 1,000. This shareholder had 100 shares, so shareholding is 10%. Now he sold he sold 50 shares to the company, so his remaining shares are 50 shares. Now, when the company buys the shares, so their total shares will be reduced. I hope you would understand, because they are no longer in the market. They are no longer with the shareholders. They are with the company. So their shareholders will be less than what it was before. So the total shares before buying the shares were £1,000. Total shares after buying the shares with the company is 950, because the 50 shares has come back to the company, so they are no longer in the market. They are no longer with the shareholders. All right. So before the buyout, it was 100 shares out of 1,000. After the buyout, it was 50 shares out of the 950 total. I hope you got this point. Let's move to the next point, which is the last point. The vendor must not hold more than 30% of the ordinary share capital. Now, after the company buys the shares, this shareholder must not have more than 30% share capital in the company. So we'll have to see that as well during these tests. All right. Now I will just cancel sharing the screen, as I will show you something on the board. As you can see on the board, I've already mentioned that this one is a capital approach, and whereas the other one is this one is the income approach, and other one is a capital approach. Now, in the income approach, as I said, that it will be treated as income. As you can see, that first we took the proceeds, so we will take the proceeds. It will be given to us in the exam, and then we'll take the cost. It will be original subscription price, and the net amount is going to be our dividends. Now, it will be net dividend. We always need to gross it up, multiplied by 100 divided by 90. Now we'll not only have to pay income tax, we'll also have to pay capital gains tax on that. How to calculate that? We always take the sales proceeds as original subscription price, and however we'll have to take the cost out of that, and that will be our either chargeable gain or capital loss. So it will be either our capital gain or it will be our capital loss. If we look at the capital approach, on the other hand, first we'll take the sales proceeds and we'll deduct the cost out of that, and the net amount is going to be our either gain or it will be our loss. Alright, so that's it for this lecture, as far as this lecture is concerned, and this portion of this video is concerned. In the next video of this lecture, we'll do a small question and we'll see the closed companies as well as this portion as well. Alright, so that's it, and I'll see you in the next lecture. Thank you.